Let's bring in media mogul and CNBC contributor Tom Rogers. He's the executive chairman of Engine Media and Gaming. Tom, always great to speak with you.
Great to be here. Thanks, Melissa.
Do you think Netflix can reaccelerate its growth? In its shareholder letter, they say our plan is to reaccelerate our viewing and revenue growth by continuing to improve all aspects of Netflix, on top of monetizing, on top of growing internationally. Can they do this?
Well, first, let me address the issue you talked about in terms of people disconnecting a streaming service over the next 12 months. People are disconnecting streaming services all the time. The monthly churn on Apple TV is 10%. The monthly churn on HBO Max is almost 7%. That's monthly. Think of what that is in a year. So there's nothing new about many people disconnecting some streaming service over the course of a year. Second thing I'd say is, as much as people are focused on streaming subscription services in a period of inflation and tightening pocketbooks, the real beneficiary of inflation, I think, is going to be Netflix. And why do I say that? Because where people are really going to cut back is their $100 cable or satellite package. That's going to go. And the legacy media companies are making it a whole lot easier for people to get rid of those when they move things like Dancing with the Stars over to Disney Plus. And you can save a lot of money getting rid of that $100, picking up a few streaming services. And I think Netflix will be a direct beneficiary of that. Obviously, the legacy media companies are going to take a hit there. So I think the question with Netflix is really this. It's obvious that the bear case is dominating in the market now, that Netflix lost subs, it went negative, and therefore its growth is stymied. I think the real question is whether Netflix growth is slowed, or its ultimate ability to get where people thought it could get as a several hundred million streaming service is still intact. It's just going to take longer to get there. Now, obviously, taking longer to get there affects discounted cash flows, et cetera, and the stock price comes down. But there's very little here to suggest to me that the preponderance of pay TV homes around the world, of which there are 400 or 500 million outside of Russia and China that are up for grabs for Netflix still, or the 600 million broadband homes that are not mobile-only type homes, but true broadband homes, aren't up for grabs for Netflix still. So clearly, growth is slowed. It's going to take longer to get there. But the long-term arc is streaming wins out over linear TV, linear demise benefits Netflix, and in the end of the day, they're ultimately going to be a much more valuable company than the market's suggesting right now.
So, Tom, you've had extremely prescient calls over your whole career. I agree with you that Netflix should be the beneficiary of this. But what levers can they pull now? Do you think they go to a two-tier system where they have ads? What can they do immediately on their behalf, not just the trend?
Well, a lot of people are pushing ads out. A lot of analysts on CNBC today begged them to come up with an ad tier. I don't think they'll go there quickly. And in part, the reason is the only place advertising is really valuable in terms of going in that direction is the US and Europe. And in the US, at an 84% penetration of pay TV subs, I don't think there's really that much upside from an ad-supported tier unless they really began to see churn. They have enviable churn. Their churn has been the lowest in the industry. If they really see pricing here driving an issue for them, then I think they could consider a lower-priced ad service. Europe, they're actually doing quite well. And the thing that people should focus on in terms of Europe and pricing and whether or not Netflix has pricing power. In the US, as I mentioned, average cable bill is $90 or $100. In Europe, it's only about $26. And they have pricing of Netflix pretty close to where it is in the US. And having said that, that comparison suggests with the same number of subs in Europe for Netflix as they have in the US, some 75 million subs, they are doing extraordinarily well to be able to price that close to what people are paying for their pay TV package. So I'm not convinced that they have demonstrated they don't have pricing power. They always face resistance when they do it but netting out FX effects over the course of this quarter, their revenue per sub was up nicely in every region, and I think that actually bodes well for their pricing. And more importantly, when it comes to competition, their viewing audience, even with the Peacocks and Paramounts and Hulus lower distributed and therefore making greater sub gains, the amount of watched minutes on Netflix has actually grown comparatively. And that, to me, suggests that the competitive onslaught that people are talking about is really not all that meaningful relative to Netflix subscribers.
Tom, it's always great to get your perspective. Thanks so much for your time.
Thank you.
Tom Rogers, Engine Media. All right, how do we trade this aside, Guy, from waiting a couple days and seeing how this shakes out? What do you think is the range we see here?
Well, I think, listen, Pete, Steve, and Karen all spoke with. The three-day rule that Steve's talked about for years is in place without question. My point is this. I think tomorrow you're going to see a huge volume day. Again, anywhere from 10 to 12 times normal volume. I think maybe you'll see a 250 print, but I think it'll close north of 260. For me, that's good enough to say, you know what? We traded down to the lows. Again, December 2018, the fall of 2019, we held. And this is an opportunity to buy the stock for a trade and look for a bounce. And I am getting added at Twitter. It doesn't surprise me. But if you start to really look at the numbers, this is about as cheap as the stock has ever been.